Okay. So, what shall I tell you today to help you a little? I see, Lee, you don't have a camera. That's okay. If you don't have a camera, then that's fine. But just to remind you, all of this is some sort of a special e-learning course, right? By the end of the semester, I have to submit all the materials to the Ministry of Education. They see how we interact, so we want to have some interaction. Hence, if you have any questions, please feel free to shoot them, right? Okay. Jenny, your camera. So, last week we started a new chapter. Let me perhaps switch to Moodle. Last week we started a new chapter, okay? And what's the main idea of that chapter? Actually, I don't need Moodle. Let's go to Paint. So I try to give you the main idea, right? Just share my screen. Like this, right? I think you are watching Paint right now. So before last week, for the first 3 weeks of the semester, we reviewed ways to assess investment, including calculating net present value, including calculating internal rate of return, and other investment criteria such as modified internal rate of return, payback period, and so on, average accounting return. But within that chapter, the first few weeks, the first 3 weeks of the semester, you were given all the details for, let's say, for example, the discount rate. Did somebody ask to join? Don't see you there. Yes. For the discount rate and even for the cash flows. So on top over here for this ratio, we have the sum of all the cash flows, right? Sum of all cash flows. But in reality, right? In reality, when you graduate, go get a job as some sort of financial analyst, perhaps in some company, it's pretty common actually to calculate net present value. Okay? So if you have to do that somewhere at your firm, nobody will give you these cash flow values on a plate, on a platter, right? You will have to be able to get these values from the financial statements on your own. That is the main idea of this second chapter, okay, which we started last week, right? So that's why I wanted to talk to you live today rather than last week, so that you had the experience of looking at the pro forma financial statements last week, so that you know what I'm talking about. So the main idea of this whole chapter is, where do we get these cash flows from the financial statements to plug into the NPV formula to calculate the NPV values, as well as other formulas, say internal rate of return. Okay, and we get those values, of course, from the financial statements, but not any financial statement, not a simple balance sheet and an income statement, because those are about the past. Net present value looks into the future. So the financial statements that try to estimate future earnings are called pro forma financial statements. So that's what you've looked at last week. Okay, a bit of a summary. I hope it helps. This week, what you're going to have a look at, again, our class today is going to be very brief. Originally, according to the application I submitted to the university and to the Ministry of Education, I had only been planning to meet with you guys like this live, face-to-face, live, only 3 times during the semester. One time in week 1 at the very beginning to explain what's going to happen. One time in week 8 before the midterm. We still will meet at that time so that you have more chances to ask me anything you want to ask me about before the midterm exam, and third time before the final exam. So all these extra meetings that we're having now are on top of what had been planned already, right? And the reason for that is because as a result of our e-learning course last semester, the comments that I got from the Ministry of Education is that we want to have more interaction, okay, between the professor and the students. Again, that's why I'm repeating. If you have any questions, feel free to ask your questions. But to come back to what I was saying, these are extra meetings for you guys to have a chance to ask me anything. Hence, they're not going to be very long, right? I'll give you the main idea of what we talked about last week and the main idea of today's class. After that, you'll have to go off and go through the details of today's teaching materials on your own. And of course, if you have any questions, you can ask me either now or in our next online class. We'll meet again before the midterm and even earlier than that. I'll give you more chances, okay? So what are we going to look at today? Or what are you going to look at today on your own? That's some more details of how do you pick up these values for the cash flows from the pro forma income statement and the pro forma balance sheet. Okay? And the particular details for today, right? The particular details for today are going to be the tax shield and salvage value. So I'm going to give you a general idea now. If you have any questions, feel free to ask your questions. After that, you'll have to go off to look through the details on your own, right? So let's start with, let's say, salvage value. Let's start with salvage value. Let's have time here, and let's say book value here. Book value, of course, is the value of purchasing an asset. Let's say your company bought a car at time 0, okay? And let's say the car is supposed to last for, just say for simplicity, for 5 years. After 5 years, you, I don't know, plan to sell the car for whatever reasons, okay? So the book value is the purchase price at time 0 minus depreciation throughout all of these years, right? That's the book value, okay? Right. At the time when you sell the car 5 years later, the actual market value of the car may be different from the book value, right? If your firm uses the car extensively, so it's a beater during the 4 years, the market value you can sell it for is like very low, even lower than the book value. Or if your company doesn't use the car extensively, if after 5 years it's still pretty new, in a pretty good condition, maybe the market value is going to be higher, much higher than the book value, right? So we have market value low here and market value high here, depending on the conditions of the car, right? Now the salvage value is the actual amount of money that you can get from selling the car. And unfortunately, it's not just simply equal to the market value, because you may have to pay tax on that. That's why salvage value, right, is a function of, or it depends on, the market value, of course, and it also depends on the tax rate, because you may have to pay tax. And it also depends on the book value, because the way we calculate the actual tax amount to pay, not the tax rate, is we have to compare market value to book value. So let's zoom in over here into this circle a little. Zooming in into that circle, this is year 5. This is time. This year 5 is when we are selling the car. This is the book value declining gradually all the time due to depreciation, right? So this is year 5. And let's say the market value is right here. This is market value, first situation. Let's give it a value of, let's say, 100,000, for example. So that's 100,000. And let's say the book value at the time of sale is, let's say, 60,000. In this case, market value is greater than the book value. In that situation, your company will have to pay tax. Okay. But if the condition of the car is very low, is very poor, okay, in another situation, so let's have another color. If, let's say, the market value is very low right here, change color, red market value, let's call it 20,000, right? In this case, the market value is less than the book value, right? In that case, you can have a tax deduction. Tax deduction or tax credit. You can take it as a loss, okay? The difference between 60 and 20, which is 40,000, you can take it as a loss. And if you have other profits somewhere else in the company from your regular activities, adding 40,000 as a loss, although it's not a real out-of-pocket cost, right? It's just that the car is supposed to be valued at 60,000, but the market value is lower. You haven't actually lost anything out of pocket, but this allows you to count this as sort of a fake or sort of imaginary loss, hence reducing the tax that you pay. And vice versa. If the market value is 100,000, but the book value is only 60,000, you are selling something for a bit of a profit. After depreciation, your cost of buying this car is like 60,000 after depreciation, right? But you're selling it for 100,000, so you have a capital gains, and you have to pay tax on that. Okay. Let's see, somebody's joining. Just 1 second. So that's the main idea of salvage value. Right? So more details in the lecture. The second subtopic for today. What was the second subtopic for today? That's let me see on Moodle. It's today. Here we have your learning objectives, salvage value, and how it affects NPV. Yeah, of course, how it affects NPV. What we learned last week, right, is how to calculate NPV and how to get the values from those performance statements where you have times 0, 1, 2, 3, 4, and 5 years. Okay, so that's year 5, year 0, and you have all your cash flows. At the beginning, a negative cash flow to start the business, then all the positive cash flows, and so on. In this case, how salvage value is going to affect your NPV? Well, if we are selling the car at the end of the project in year 5, that just adds to the final cash flow. Okay, right. And particularly the salvage value, let's have an example here. Let's say the tax rate is 20%. Right, so we're looking at the black version, not the red version. So the market value is 100,000. So when you sell the car, the buyer of the car will give 100,000 to your company. Woohoo, nice. But the book value is supposed to be 60,000. We pay tax not on the full value of the car, not on 100,000, but only on the profit part, this 40,000. So the actual salvage value is going to be the sales price, 100,000, minus the tax rate times the profit. The profit is the market value minus the book value. So there's the formula for salvage value for you, but you will also see it in the lecture notes as well as in the video. Okay, so in our particular example, 20% of the 40,000 profit is 8,000. Correct me if I'm wrong, I'm just doing the math right now in my head. I didn't prepare these numbers beforehand. I just took the numbers out of the blue right now. So the profit of 40,000, 20% tax on that, that's 1/5. 1/5 of 40,000 is 8,000. Correct me if I'm wrong. So out of the 100,000 that the buyer will give your company for the car, you will have to pay 8,000 as tax, which leaves you with a salvage value of 92,000. So that will add to the cash flow at year 5. Or for the red example, let's change color again. For the red example, how much is my salvage value? Well, the market value is only 20,000. Let's switch here. The market value is only 20,000 minus the tax that I have to pay on the difference between the market value, which is 20 in this case, and the book value, which is 60, right? So it's the same formula. Even though I get the tax credit back, I don't need to change any signs because automatically minus will give me plus. I get more money in addition to the money I get from the buyer. So the buyer gives me 20,000, but I also get a tax credit, the 20% of this 40% of this 40,000 loss, which is again 8,000, and my salvage value is going to be 20,000 that I get from the buyer plus a tax credit of 8,000, 28,000. Okay, so that's what we're gonna do today. You'll have a chance to have a look at the details, and while we have a lot of students right now, 20 participants, so 19 students I guess. Let's check the attendance. So in the chat box, in the next 30 seconds, type your student ID. Let's see if I'm recording. Looks like I am recording. Okay. Attendance of these live classes is also graded, although the score allocated to this attendance is very low. It's only 3 points allocated to attending all of these classes. How many we have? I'm not sure. Let's say we have 6 classes during the semester, online classes. That means only half a point for each time you attend. Okay, so I think more than 30 seconds have passed. Let's scroll a little up and down so that we can check the attendance on the recording later on. Okay. Right, so that's that. What else? Oh yes, and the tax shield from depreciation. Tax shield from depreciation, one more subtopic for today. Okay. Let's go to black color. Depreciation. How do you guys think? Is it a cost or is it a source of revenue? Anyone? If you look at the income statement,
it's a cost.
Of course it's a cost, right? Because we start with revenue, which is price of your sales products times the quantity. That's the revenue, that's all, minus all the costs, subtracting depreciation as well. Very good, yes. I think that was Andy, right? I didn't see look at the screen, but just by your voice. So it's a cost, but the cool thing is it's not real out-of-pocket cost, because you don't pay for depreciation with cash. It's not a real out-of-pocket cost. What is depreciation? Well, you bought a car, right? Let's say you bought a car for 1 million NT, let's say. And according to the accounting rules, vehicle's supposed to last for 8 years. So we depreciate about 12% every year. So 120,000 will be counted as a cost. But you don't actually pay it out of pocket. It's just that on the balance sheet, the value of the car declines because we keep using it, right? So the book value declines. So we can claim this to be a cost, although we don't pay that cost. So if we have the cost on the income statement, it means we pay less tax, right? But I didn't have it as a real cost, so it kind of protects me from the tax, even though I didn't have to pay that cost. That's why depreciation has a tax shield, okay? And that's one more subtopic that you will have a look at today on your own. How to calculate that tax shield, it's pretty easy, you'll have a look at that. Okay, so just a quick introduction. Again, these are extra classes. Before the midterm, we'll have a full class just online so that you can prepare for the midterm a little bit. And for today, I think some of you wanted to ask me questions. Is Ricky here?
Yeah, I'm here.
Oh, Ricky.
Yeah.
Yes. I saw you yesterday, right? You wanted to ask me something. Was it yesterday or the day before yesterday? I'm not sure.
I think 2 days ago, I think.
Mm-hmm.
Yeah. And should I ask right now?
Yeah. I'm finished for today. The general summary. For the details, you guys have to study on your own. Remember to take the test today. Just 1 second, let's double check. The test is before 2 p.m. So make sure you take that test before 2 p.m. It's very simple, only 4 questions, should be easy enough, okay? So I'm finished with what I planned for today. Anyone or Ricky, anyone, if you have any questions, ask your questions.
So can I ask first?
Mm-hmm.
About last week test, and like I tried to solve the question by following your explanation, but I got wrong. So I just want you to explain again. Okay, like I will.
Let's have a look at it.
Let me see. Yeah.
So let's have a look at it. Last week, week 5, test 4.
Yes.
Here. So you got this wrong and this wrong, yes?
Yes. About something like a calculation.
Right. Okay. So here, this is your answer.
Yeah.
Okay, so assume that you are planning to launch your small business. Expected sales are 2,000 toys per year. Let's open Excel. We'll need Excel for that. Okay, so quantity will be 2,000, right? Do you guys see Excel in front of you?
Yes, Professor.
Okay. So the price is going to be 500. Okay. Your cost per using each toy is 300. So that's variable cost. Variable cost 300. Additionally, fixed cost 20,000. Fixed cost 20,000. Initial cost purchasing equipment is 380,000. So that's let's call it equipment cost 380,000. Equipment is expected to depreciate completely in 8 years, straight line depreciation. So depreciation in 8 years straight line, so every year the same amount is going to be this divided by 8, right? Okay, straight line depreciation. Net working capital required for operation is 30,000. Okay, so net working capital should be 30,000. And your tax rate is 30%. Cost of capital is 11%. Calculate NPV over the project life of 8 years. Okay, so we need to make the income statement so that we can find 3 values. Remember from the explanations last week. For NPV, Just remember, three values I need to calculate. Operating cash flow, basically the cash flow from regular activities. Then the cash flow from selling and buying long-term assets, that net capital spending. Net capital is long-term asset, net capital spending. And cash flow from buying and selling short-term assets, that's net working capital. That's all, okay? So for operating cash flow, that's EBIT, right, plus depreciation minus tax. So I need to look at the income statement. Okay, so let's have a look at the income statement. Revenue is going to be 2,000. That's quantity times the price, 500. Okay. Variable cost, that's per unit. So again, that's quantity, which is 2,000 times the variable cost of 300. Okay. We have all the other costs, fixed cost, depreciation, interest expense, admin expense, advertising expense, and other expenses. Okay, I'm just going into more details just in case if you see these on the exam. In this particular case, the company didn't borrow anything. We assume we don't borrow anything because the question didn't tell us anything about the interest expense. So it's all zeros. Admin expense, nothing in the question about the admin expense, 0. Advertising expenses, 0. Other expenses, 0. So let's have it so that we're all on the same page in case if you see that on the exam. Fixed costs, 20,000. Depreciation, where is it? 47,500. Okay. Let's put the interest expense over here because revenue minus all costs except interest will give us EBIT, earnings before interest and tax, right? So that's revenue minus all costs except for interest expense. Then EBT, earnings before tax, right, is EBIT minus interest expense. Okay, and then the tax payment equals the tax rate times EBT. And then we have net income or profit, right? That's earnings before tax minus tax. We actually don't need all of this to calculate operating cash flow. But just to complete the income statement, again, to make sure everybody's on the same page, if you have to complete it for the exams. Now let me move it a little bit here because this will be year 1, year 2, year 3, year 4, year 5, 6, 7. We also need year 0 because at the beginning we have to buy the equipment. So this is year 1. Operating cash flow equals, right, EBIT plus depreciation minus tax. Bam. Okay, let's copy these numbers. Okay, copy this. There it is. And in today's examples, the values will change from year to year. So let's say, for example, at the start of the business, before your business is popular, you might have low quantities for sales. Later on, the quantities might grow. So these earnings will actually change from year to year. Okay. Okay. So these are the operating cash flows. 1 of 3 pieces done. Net capital spending. Well, at the beginning, we need to buy this equipment, right? So we have a net capital spending. We don't need to make it negative because the spending is already in the name. So that's 380,000. Okay. In today's material, you will learn about the salvage value. That's the price of selling this equipment back to the market, in which case selling is opposite of spending. That will be negative value over here. Let's say we sell it for 23,000 after tax. In this particular example, we don't have anything. So that's going to be something new for today. In this case, just net capital spending at the beginning. Okay. Do we have anything about the salvage value? I didn't see anything about the salvage value. Okay. And lastly, net working capital. So it's short-term assets, different kinds of short-term assets. We don't have depreciation for short-term assets. We don't apply depreciation for short-term assets. Think of it as, let's say, some cash and coins in your registry, in your till, you know, this machine. At the beginning, to run the business, you need to put some cash and coins there, right? At the end, when you finish the business, you can take all that cash and coins back. So net working capital, without any depreciation applied, at the beginning needs to go into the business. Oh, the formula is the changes in net working capital. So at the beginning there was nothing, and then you put in 30,000 into the business. That's positive change from the business perspective, although you take money out of your pocket and put into your business. But from the business perspective, that's a change, positive change, increase in net working capital. At the end, when the business is closing down, you can take that money back to your pocket. That's a negative change for net working capital, okay, as on the balance sheet. That's all. Once we have these three, we can calculate cash flow from assets, and we can use cash flow from assets to calculate net present value, NPV. Okay, so let's calculate cash flow from assets. Formula to remind you, right? That's operating cash flow minus net capital spending minus changes in net working capital. Right? So that equals this minus this minus this. So year zero in yes, true, we have a cash outflow of 410,000 in year zero because we had to spend 380,000 to buy the equipment and also put short-term assets into the company of 30,000. Together, we lost out of pocket so far 410,000. So it seems to be correct. Now we just copy this formula. These are the cash flows. Okay, now let's calculate NPV equals NPV, open the brackets, rate. So our rate is 11%. And the values. Again, it's funny how NPV was programmed into Excel. We start from value 1, not from value 0. Value 1 is here, so we enter all of these values. And we have to add the original cost by hand. There it is. I'm not sure why it's different from my previous Moodle answer. Did I make a mistake somewhere? 2,000 toys, 2,500 price. So variable costs 300 times 2,000 the quantity. Fixed costs 20,000 indeed. Okay, all those numbers correct. Depreciation 380. Let's see. Equipment purchased for 380,000. The equipment is expected to be depreciated completely in 8 years, straight line depreciation. So all the way down to 0 because it's completely in 8 years. So depreciation every time 1/8. So it seems to be correct. Depreciation is this value divided by 8. Okay, net working capital 30,000. Tax rate is 30%. NPV 11%. Okay, 30%, 11%. Earnings before interest expense. Revenue minus. The formula seems to be correct. No interest expense. Do we have interest expense? I don't see anything here. Okay. Earnings before tax, EBT, minus interest. No interest anyway. These values are the same. Tax payment should be 30% of EBT. So 30% correct, 0.3. Profit, EBT minus the tax. The formula is correct. All these values are the same as the other ones. Let's see this. Operating cash flow plus depreciation minus tax. That seems to be correct. All the values here are the same. 380,000, all zeros typed correctly, right? Why did I get a different number? What if I have 0 here? No. What if 0 and 0? No. Okay. Perhaps originally when I was calculating this, I made a mistake. Okay. Well,
No,
Ricky, it
right.
looks like your answer is not correct anyway. You see the difference? That's your answer, that's my previous answer, but now it looks like I made a mistake before as well. So what I'm going to do is I'm going to look at this problem again today or tomorrow, enter the correct answer, whether this was correct or not. Looks like I'm getting 925,000 right now instead of 1 million.
Professor,
Yep.
the NPV formula might be incorrect, but the value is correct.
The NPV formula is incorrect.
The NPV
Let's
formula.
do it again. So equals NPV, open the brackets, the rate. The rate is 11%, 0.11, comma. Values starting from value 1. So this value 1, we don't start from value 0. Bring all the values here, cash flows from assets, close the brackets, plus the original cost of 410,000. Seems to be correct. How did I get 1.1 million last time? Not a huge difference. The difference of how much? 80,000. Where could I have lost 80,000? Did I like have a typo here before? 300,000. Let's give it more space. That's still 1,005,000, not 1,045,000. Well, in either case, this is how we find the solution to this problem. But for this particular test, I will double check again, triple check, change this correct to correct answer, and recode if your answer is correct. And let's say your answer was 925,000 and it's showing incorrect now, it will show correctly in future. But Ricky, in your case, looks like your answer is not correct in any case.
Professor, can I?
Yep.
Yeah, I just like rechecked again. Then mine is just like I misunderstood that like tax payments. Like I got like what is this? All times EBT. So I got wrong, and I think your cash flows is only for 7 years, so you should be 8 years.
Ah, maybe here's a mistake. Let's see. 1, 2, 3, 4, 5, 6, 7. You're absolutely right. Thank you very much. So let's make it to 8 years. Control C, Control V. I don't know how I missed it here, 8 instead of 7. So let's move this number here, this formula here, and this formula here. Let's recalculate NPV equals NPV, open the brackets, 11% values from the 1st to the 8th, plus the original cost here. Okay, right, so originally I did put the correct answer here. Thank you, Ricky. You found the mistake here today.
Thank you for your explanation.
Great, we help each other.
Professor?
Yep.
I have a question about week 4 assignment, the week 4 quiz.
Uh-huh.
I also like cannot calculate right. Can you check it for me again? Like week 4 one.
This one?
Yeah. Yep. The last one.
Right. Your company is considering a new investment project. It will generate the following cash flows over the next 5 years. 10,000, 20, 30, 35, 30. The current cost of the investment project is 100,000. So we need to invest 100,000 first. Average book value of assets will be 120,000. Net income over the 5 years will be these values. How much is average accounting return? Okay, so average accounting return. Average accounting return is average income or average net income or average profits over the average book value. So should be pretty easy, right? So actually, although we have a lot of data here, some of the data we don't need. like the original project cost. It's just not calculated by the average accounting return.
I think I know how I wrong. Like I just write only 0.16 and 3C3. I don't write it down.
Sorry, say it again.
Like,
I didn't catch it.
I mean, like the answers, I make it right, but I only just write like 0.16 because I thought it's like a.
Ah, I see.
You know what I mean, right? So.
That's unfortunate. Yeah.
Oh, okay. Got it.
I don't want to change it. So next time, like guys, let's maybe have 3 digits after the decimal point. Let's see. If we go to Moodle, how did I program it? So that's a test number what? Week 2. Did you say it's week 2?
No, it's the week 4.
Week 4, test number 3. Yes.
Yeah.
Average accounting return. Is it this one? Yes, it's this one. Okay. So, okay, yes. I also have a margin of error plus minus 0.01. Okay. So, any numbers between this and this would still be counted correctly because I have a margin of error, right? So, okay, let's cancel it. So, where was your question? Probably lost it. Anyway, because I have a margin of error, plus minus a little bit, whether you have 3 digits after the decimal point or 17 digits after the decimal point, there will be a range, plus minus, right? So if you have too little, that's a bit problematic. But if you have too many, that's no problem. You'll still be within a range. So generally, it's a good idea to have more so that you're correctly within a range. And if you don't want to have too many, maybe let's have 3, right? Because the reason for that is because I try to program Moodle so that both percentage values and the fraction values are both counted correctly. So 0.1633 will be counted correctly, and also 16.33 will be counted correctly. If I only look at 2 digits after the decimal point, then in case of the fractions, it's only 0.16. How about 3? So 16.3% is kind of different from 16%. Okay, so I don't really want to change this one in your favor. In the future, let's have maybe 3 decimal points after the decimal places after the point. Okay, for everyone.
Okay, thank you, Professor.
Yeah, thank you. Anyone else for questions?
Yeah,
Yep.
I have a question. Professor, are we going to learn different types of depreciation methods apart from straight line?
Let me try to remember.
Did you get it?
I understand your question, yes. So there is an accelerated depreciation and a straight line depreciation. For accelerated depreciation, we have a particular table in the textbook for, let's say, a vehicle which are supposed to last for 8 years. There is a table in the textbook, but you guys don't have a textbook. I don't remember if I put the table in the lecture notes, the PDF files, which says specifically in the first year, let's say 24% is depreciated. In the second year, let's say 22% is depreciated, and later the depreciation decreases in percentage-wise. Are we going to have these sort of questions on the exam and on the weekly tests? Hard to say. Very, very unlikely. If there is a question like that, I haven't made up the exam questions yet. I pretty much have the test questions prepared in advance. I haven't got the exam questions yet, so I'm not sure about the exam. So if there is a question like that, okay, the question will also have a whole table in it saying that according to the accelerated depreciation scheme, depreciation in the first year is going to be, let's say, 24%, depreciation in the second year is going to be 22%, depreciation in the third year is going to be this much, and so on. Okay, so the answer to your question is, I'm not certain. There is very low chance, let's say 10 to 15% chance there will be a question like this on the exam, but very low chance. And if there is, I will give you a whole depreciation table for the accelerated version. Very unlikely. Okay.
Okay, thank you.
Any more questions? Well, let's stop presenting actually. Okay then. Good luck, guys. Have a nice day. And have a good weekend. Tomorrow is a working day, Saturday. Yeah. Okay, guys. Good to see you. Bye-bye.
Bye-bye, Professor.
Thank you.
Thank you,
Thanks.
Professor.
Mhm.
Thank you, Professor.